Thank you very much. It's a pleasure to be here. My gosh, there's so much to talk about. It's insane. It is insane. Trump, love him or hate him, as I was talking to someone earlier, is absolutely exhausting. And you never know what's coming next. I haven't checked my Twitter feed in the last 30 minutes, or his Twitter feed, so I don't know who's being hired or fired. So the economy could be going to hell, but the stock market was up. I just looked 5 minutes ago. I think we're okay. And I'm going to say a whole lot of things, and the economy is good right now. We're going to enjoy 15 to 18 months of really a robust economy. That's the important thing in the short run. But everything is predicated on who knows what's going to happen next. You know, trade wars are now a possibility and so on and so forth. 3 months ago, I was optimistic 3 months ago, but not as optimistic as I am now in the short run because of unexpected things that have happened. Budgets that passed, tax reform that took place, and so on and so forth. So I simply have less certainty about what's going to happen going forward than I have had in the past. But with that in mind, I have rarely been more enthusiastic about the near-term future than I've been. Okay, that's a mouthful. But I'm really, next 12 to 18 months, my gosh, I am a very optimistic guy. The chances of a recession the next 12 to 18 months is remarkably low. That's really the takeaway message. Yes, we're late in the late innings of a ball game. That's true. But just because we're in the late innings of the ball game doesn't mean the ball game is going to end badly or end soon either. We can go to the bottom of the ninth. Maybe there'll be extra innings. You get the idea. But things are good. In the long run, we have some problems. I'll talk about them. I'm not a Pollyanna by nature. I'm a pessimistic guy by nature. But this is the next 12 to 18 months. My gosh, we've rarely had as much fiscal stimulus coursing through our economy as we're going to be having in the near-term future here. So, you know, this notion of an economy that gets tired and stops working because we're late in the tooth of a recovery, think about it like this. You get up in the morning, you work. You have to work every day, pretty much, to pay your bills, right? We all have that problem. Do you say, wow, I've worked 9 years in a row. I'm going to take a year off. No, people would like to. Yeah, I heard a yes somewhere there. But you don't. The economy is the same way. There are problems we face as we get long in the tooth, and we'll talk about those. But just because we're long in the tooth doesn't mean it will end. There are some ways it will end, lack of labor and mistakes by the Fed, which we'll get to. But hey, sit back and generally expect to enjoy the next 12 to 18 months. Really, why? Why am I so confident about this? Well, this is what GDP, this is all the goods and services our economy produces, and you can put them into 4 buckets, if you will. The first bucket, C, is household consumption. We're going to go into detail on all of these, but in short term, I'll talk quickly, then you can look at your phones for 5 or 10 minutes, and you can ignore me, and then I'll remind you when to start looking again. C is really good. It's fine. We're creating jobs. There's some wage growth, not enough wage growth, not enough job creation for different reasons both, but there's enough of each. That's going to be the juice that gives us all a little more money and more people working, more money. That's fine. I, corporate investment, should be very good this year. It was already very good last year, or mid to late last year, and it will get better this year because tax reform has made investment cheaper for firms and corporations. The deduction and depreciation schedules are more favorable. They can expense things and so on. And firms are starting to run out of capacity a little bit. The third term is G, government spending. We know that's going to be terrific because of the tax reform that took place and the spending increases. We'll get into some of that. The last bracket's exports minus imports. I know it should be E minus I, but X minus M looks so much better, you know? So I'm pandering here, if you will. And that's going to be bad. What's happening there is exports are doing well. We're going to export more than we ever have this coming year. We'll break records on exports. The problem is we're also going to break records on imports. Our economy is growing pretty fast, and the faster our economy grows, the more we import. That's part of the issue going on here. So C is going to be good, I is going to be good, G is going to be surprisingly good. Unexpected this late in the business cycle to have strong G. Usually when you have strong C and strong I, you don't have strong G. But we have strong government now because of tax reform, as I mentioned earlier, and some weak exports. Let's look at the details. Let's see why I feel so optimistic about this. Look, the stock market's doing well. If you own stock, if you own bonds, if you own a house, if you own a rental property, if you own commercial real estate or industrial real estate or a self-serve thing or a self-storage thing, This is a good time, right? Things are good. Everything's up. We all think we're geniuses. If you're a day trader, yeah, everything you touch is gold, except Bitcoin the last month or two. But we can talk about that later. The stock market's up. Next, household wealth is way up. It was $55 trillion at the bottom of the recession in 2008, right there. And now it's almost 100 trillion. So it's gone from 55 trillion to 99 trillion, something like that. It's almost doubled. In the past, that would have caused a tremendous amount of spending to be unleashed because we're all feeling rich. But it's less now than before. In part, it's because we've been traumatized by the recession. We remember this near-death experience when our portfolios went to nothing, and we're nervous that it might happen again. It's also a case of we're older. The average U.S. age keeps drifting up. Boomers are getting older, population growth is slow, and we'll talk about that too. And older people are a little more reluctant to spend. After all, my mom is 81, and she thinks that if she doesn't spend her money, she'll live forever. She dies when the money runs out. There's this psychological belief, you know what I'm saying. So it's helped spending, but not as much as we thought. But we have more wealth, the stock market's good, we're borrowing more money. That's a good sign too. And we're not borrowing irresponsibly. This is not the way it was in 2008. If you look back here, that was the peak of borrowing back in the boom of the housing boom, 2008, right there, right? On this graph, it's right there. And then what happens? We borrow too much. It was too easy to borrow. Anybody could get a loan. My dog that we didn't have got asked for credit cards. My daughter at the time was 8. She got 2 or 3 a week. I mean, it was remarkable. No dog, option only, liar loans, whatever. And then things go to hell. Now, they only go to hell because they shouldn't have gotten this good in the first place, right? Why? What went wrong? What went wrong was this. The yellow is mortgage debt. And notice here, this rapid increase in mortgage debt. This is the telltale sign of a problem. And when you look at that graph, I want you in the back of your mind to think you're at a rock concert. A rock concert of my favorite group, or one of my favorite groups, AC/DC. And the guy is singing, Highway to Hell. Because that's what this is. This is the mortgage highway to mortgage hell. When you borrow this much money, this quickly, the rate of increase is so fast, you're just giving money to anybody. And because we gave money away, people could afford to pay more money for the house, driving prices up. Builders built more. It was all based on just cheap available credit. Very different than it is now. Now it's a completely different story than it was then. You can see it here. The rate of growth in mortgage debt today is very shallow. The slope is very shallow compared to the steep slope right here. And that's why I'm concerned about the housing market. We'll talk about that. But in a very different way. There it was pure profligate, stupid lending that just drove us over the edge. The problem we have now is different. Well, the problem we face right now is the red. The red student loans. They're getting pretty large. They're bigger than credit cards and they're bigger than auto loans. And if you graduate college or graduate a 2-year degree program or something, and you got $300 a month in credit card debt, auto loan, and $300 auto's green, by the way, and you have $300 in a student loan, that's a lot of money. I mean, the average age of a realtor is like 109, they keep telling us. Economists also. I worry I have to live forever because no one's going to replace me. But anyways, so we forgot that when you're 23 or 22 or 25, $500, $600, a lot of money. Now that's what you spend on recreational weed, It's a different situation out there. So it's going to delay them to get a house. So you know that like the great generation, the ones that fought in World War II, by the time they were 20, they had fought in the war, gotten married, had a kid, and finished college. Right. Nowadays at 20, we're like still sucking our thumb. It's just taken longer for us to mature as we go more education, more debt, and so on. But they'll get there. They'll live longer than we are. They'll work longer than we will, and so on. But this is what's delaying household formation nowadays is the student loan problem, right? We'll get over there. But despite this problem of debt, but the total debt's not that high. The total debt today is barely higher than it was 10 years ago. And the economy, of course, is 20% bigger, 22% larger than it was then. So household balance sheets are good, and interest rates are much lower now than they were 10 years ago. So disposable income, the percentage of disposable income going to pay mortgage, car loan, student loan collectively as an economy is less than it was. So we're fine, thank you very much. And stock market's up, bond market's up, assets are up. Look at this, we're happy. This is important. Happy consumers, happy households don't necessarily spend more, but let me tell you, unhappy ones spend a lot less. That's for sure. When you're unhappy, you spend nothing. So let's see how you spend your money. The question here is as follows. Are you spending your money buying fun, frivolous things? Or are you spending your money buying, T-shirts and oatmeal cookies and Payless shoes? That's not so good. But if you're buying cars and boats and going on trips and buying diamonds, that's a much better sign of an economy that feels good and that people are happy with. But first, look at small business. That's you guys. You're all small business. You all run your own businesses, right? You get some help from the broker and the company, obviously, but it's all up to you, and your self-motivation and drive determines almost entirely the success of your business. And look how happy small business is. Small business is ecstatic. This is the highest it's been in easily 10 or 15 years, right? And it's a hairbreadth away from the highest ever, which was in 1983. Small business is happy because there's been tax cuts. Small business is happy because there's been deregulation. Banks are a little more willing to lend, right? All these things that have happened have caused small business to be very happy. So households are happy, small business is happy. Oh, big business is happy too, right? The tax cuts them, they're repatriating money, they're investing, they're doing mergers and acquisitions, they're increasing dividend payments. I mean, there's money coursing through the economy here. So let's look at this. Nothing says you're happy, at least in my opinion, than going to Vegas. That is the telltale sign of success, right? That means we're happy. It means you're happy enough to really spend money you don't have on things you really don't need, right? Vegas is expensive. Trip costs money, food costs money, and some people call it gambling. I resent that. It's not gambling. Think of it as investing in very risky, short-term financial assets. It changes your perspective, and I think it should become deductible. Because when you're in small business, life is risky, and you can learn to hedge. You bet, like on a roulette wheel, you bet on 12 or something, I don't know. And then you say, whoa, what if it's not 12? I'll put a few bucks on red or blue or black, right? Red or black, and that's hedging. I mean, you can learn awesome skills, craps and blackjack. These are phenomenal, and roulette, great games. Anyways, all-time attendance at an all-time high. Corporations going to Vegas. I'm not sure why corporations go to Vegas. Sending a corporate staff to Vegas to do committee work is like sending a 9-year-old to Disneyland to do homework. I mean, some might get done, but it's completely accidental. But we're going to Vegas, that's great. And the blue lines, the vertical lines, those are households going, people going, and those would have been a record were it not for the shooting that took place in September. So it's been a great year for Vegas. But we're not done. We're buying cars. We're buying plenty of cars. We're buying 17 million cars. Yes, it's down from where it was a year ago. The numbers are a little bit weaker of late. But that's just because we're done. We're carred out. Cars last a long time. There was a catching up of purchases in 9, 10, 11, 12, 13 because we underpurchased in the depth of the recession. And then there was recently a huge boom in car purchases following the hurricane disasters in Florida and Texas. But now we're done. We're back to equilibrium state, 17 million a year. Cars are $35,000. They're expensive. People don't buy sedans anymore. 2/3 of the cars being bought now are crossovers and SUVs, right? So cars are expensive. We're good on cars. We're going to Vegas. We're buying cars. Oh, we're fixing our homes up. That's even more expensive. So Vegas costs, $3,000, $4,000 for a vacation. I mean, it could be more, but, let's forget that. We buy a car, $35,000. Fixing your house up, that's really expensive, right? I mean, a kitchen rehab, what, $50,000? A pool, $50,000. A room, $100,000. I mean, this is real money. This is stimulating the economy. There is, however, a dark side, if you will, to the home repair part. Part of the problem is there's no homes to buy on the market. And because you can't buy your dream home, you will turn your existing home into the dream home. It's like, if you can't be with the one you love, love the one you're with. One of the worst songs ever. But this is really what it means. You're going to love your own house because there's nothing else to buy. So we're going to embroider that sow's ear till the cows come home. So the good thing is you're helping the economy with that, sure. But the problem is, once you dump all that money into your house, you're not going to sell your house. So it is removed from the possible inventory of for sale homes that are available, depressing inventory further, jacking up prices. So this is not a great thing necessarily, but it is what it is. So we're spending a fortune on a home renovation, but we're not done. How about buying a $500,000 racehorse? No one here's thought of it, I know, but you should. Something to think about going forward. You have a few extra dollars, you get a good commission, you know, buy a racehorse. Look at the sales. They're back where they were. It's taken them 8 or 9 years, but they've recovered. It's not just Americans buying horses here, it's Europeans, it's Arabs and so on. I mean, lots of folks like horse culture, right? But total sales are good. So we're buying cars, we're buying home renovation, we're going to Vegas, we're buying racehorses. How about a plane or an RV? So what we're looking at here is the yellow line or the orange line. It's very high. It's as high as it was, the best we've been at since the early parts of last decade. That's a 13 or 14-year high in boats, planes, and RVs. So we're buying a lot of very frivolous things because we're feeling good and confident. Unemployment is low, wage growth is decent, our portfolios are better, and you can see it reflected in the behavior of households. I'm not making this up, really, I'm not. So we're pretty good. So you put it together, this is the change in C, that first component of GDP I was talking to you about. Almost 68% of GDP is C. It includes healthcare. It's going up pretty nicely. This is what, 2.75% roughly. That's 3, that's 2, so 2.5 is there. It's about 2.7, 2.75. It's not spectacular. It's not nearly as good as it was in the last recovery here during W's presidency, when it was easily averaging 3 or maybe 3.1 or 3.2, but it's okay. The problem is the rest of the economy. This is growing at 2.75, and it's been doing that for years, right? Several years, 5, 6 years, at least, some years higher. But the rest of the economy is in the doldrums, relatively speaking, and that's why overall GDP growth is 2.2. This is 2/3 of GDP at 2.7, and yet overall GDP is 2.2. That means the remaining third must be like in the ground somewhere, right? And those things are probably going to improve. Corporate investment is going to get a little better. Government spending is going to get a little better. Exports a little worse on net. So why is corporate spending going to get better? First, there's the tax reform. Tax reform has made the cost of capital for firms much, much cheaper. They can now purchase all kinds of things and expense them right away. There's very favorable treatment of corporate investment in plant and equipment. So firms will invest. Second, unemployment is very low. It's hard to find workers, and the workers you find are generally stoned. So it's cheaper to buy a machine. So firms are buying machines and equipment and equipment and algorithms and artificial intelligence and robots and whatever it is. And wages are going up a little bit now, a little faster than they were before. So higher wage growth, fewer workers, better treatment of deductibility and expensing of capital equipment. Those are incentives, but moreover, oil prices. The U.S. is now the world's second largest producer of oil. We just surpassed Saudi Arabia. And by the end of this year or early next, we'll probably surpass Russia as the #1 producer of oil. In the past, cheaper oil was good for the U.S. Now it's not. It's good for households, you and me, but not for the firms that produce and look for oil, drilling and services and so on. You see here, at the price right now of $60-65 a barrel, it's perfect price. It's perfect. The rig counts are going up. That's the layer cake here. This is different plays, the Permian Basin being the most important. And this is the price of oil, the squiggly line. And as the oil price goes up, about 4 months later, rig counts go up. They're never going to get back to where they were at 1,200 because the oil drillers and explorers and exploration and production firms are much more efficient in drilling. They can drill miles down, literally miles, and they can drill miles horizontally too. So they can drill really well, they frack really hard, and they get tons of oil out. This is good for the economy. Looking for oil is expensive. Moving oil to a refinery is expensive. Building refineries is expensive. This is 50, 60 billion bucks of GDP here. This is going to add a third of a point. So oil prices are at the happy medium, high enough for the firms to be happy in exploration and production, and low enough for households not to go, whoa, I'm going to walk, or I'm going to carpool, or not do whatever it is I'm going to do. Next, corporate profits are very good, and this does not include Q4. Q4 is just finishing coming out now. And Q4 numbers were great. They were terrific numbers. And Q1 looks terrific as well. The guidance from firms in Wall Street about what's going forward, they're all very optimistic and very happy. So while the market may not be going up much of late, last couple of months, earnings are going up, and that certainly supports where the stock prices are and price to earnings ratios are. Is the stock market overvalued a little? Yeah, probably a little, but nothing to be particularly perturbed about. Could we have a 10% correction? Easily. Could we have a 20% bear market? Sure. But the fundamentals, at least in the short run, are very, very good. So corporate profits are good. Oil prices are good. Manufacturing is good. Look at the far right on this graph. This is a whole bunch of different measures of manufacturing by different surveys, if you will. And the manufacturers are as happy as they've been in 15 years. That's 2003, 4, 5, right? They're very happy. They're only 10, 12% of the economy, but they're very happy. How about the rest of the economy? Non-manufacturing, services, Starbucks, right? Expedia, Travelocity, those companies. Every other thing, also daycare services, education services, healthcare services, realty services, for example. Whoa, look at the blue line. It's really high. It's around 60, even if it were 55. This is very high. It's a 10-year series. It begins right when the recession starts in 08. Beautiful series. Manufacturing's happy, services are happy, small businesses happy, households are happy, big businesses are happy. We're buying cars, we're buying boats, we're buying planes, we're going to Vegas. This is not bad news, right? And then you look at this. This graph is so beautiful, I'm going to sit down and enjoy it with you a little bit. So what this shows is firms spending in equipment, not plant, but equipment. And you can see it was bumping very nicely. It was bumping very well up here at a high level. Then the oil prices go to hell. The dollar starts to strengthen substantially. Manufacturing goes into recession, and it collapses. And then it recovers. And then it goes, okay, it's down a little bit of late. Yeah, nothing goes up forever here, right? Nothing is perfect. But this is saying firms are investing in plant and equipment. And you talk to CEOs, all the surveys of CEOs say, yeah, we're planning to invest in some plant and equipment. With the money we get back from the tax cuts, much of it will go to dividends and so on, and mergers and acquisitions and other stupid things. But some will be used for plant and equipment. And we need more plant and equipment because that raises the productive capacity of our country. And we'll get back to that theme in a minute. But this is certainly going up, is pushing up GDP. So we should have a good 18 here. Good 18, good 19. Now, next comes government spending, G, the third term in GDP. And here's where it gets weird. Normally, if C is good, corporate household consumption, I is good, corporate investment in plant and equipment, you don't need big G, because unemployment's already 4.1%. You don't want to overstimulate an economy, because if you overstimulate an economy, you get inflation, right? Because you own a business that makes pizza, okay? You have a business, you're a realtor, but on the side you sell pizzas. So you want to hire more people because we all have a tax cut. We all have more money. We all have $100 a month more money, 50 bucks a paycheck, whatever it is. We want to buy more pizza. But you can't hire anybody because unemployment is really low. So what do? You can't hire more people, and someone said it, you raise prices. That way you can make more money. You know they have the money, you know they want to spend, but you can't oblige with more pizzas. Just jack the price up. And if we all start jacking the price up, we get inflation. And if you get inflation, the Fed starts to raise rates. So what could happen is we have very lax monetary fiscal policy now, tax cuts and deficit spending and all that sort of stuff. And then inflation comes, the Fed raises rates. We don't want that. That would not be so great. That's why government spending rarely goes up late in a business cycle. because you're already prone to inflationary tendencies because unemployment's already pretty low by the 7th or 8th inning of a ball game, right? But this time we're doing it in spite of the fact that we're in the late innings of a ball game here, of a recovery. So we're playing with a little bit of fire, not a tremendous amount, I'll explain why later, but there is some. The key thing to look at here is how long will this fiscal stimulus last? And there are two kinds. There's the blue color and the red color, right? The blue color is tax cuts. And they lowered revenues because they cut taxes. They had tax reform on one hand, which we'll talk about later in terms of house prices, and they also lowered tax rates, which caused deficits to rise. That's the blue. Then in early February, they also increased spending by $300 billion over 2 years, equally divided between defense spending for the Republicans and discretionary spending for Democrats, health care and CHIP and all those other things, right? They both got to waste money in their preferred way. But nonetheless, $150 billion a year of extra spending, and on top of that, some hurricane relief too. So there's a lot of money coming from spending increases, red, and the tax cuts, B. But notice that by the end of 2019, they end. It's done. The spending is 2 years, so by definition, 2 years from 18-19, we're done. And the tax cuts will have been fully implemented by then from the tax reform, and it'll be done. We'll be over. That's why I can tell you with pretty good confidence, the next 12 to 18 months looks really good. After that, the stimulus goes away. Rates may be a little bit higher. Unemployment a little bit lower. I'm not saying we're going to have a recession. No. But I'm saying the probabilities of having one rise. So next, enjoy the next little while and be prepared for what could come down the road come 2020, late 19, early 20, mid 20, whatever. And the reason the problem here is because this fiscal stimulus is strong and it's all because of deficit spending. There's no revenue here. It's going to make our deficits worse. This was the trajectory of our deficits prior to the tax reform. All right? But you can see by the year 2027, the deficit was already 5% of GDP. You only get it that high in a recession, right? There was 1 year when Reagan had it. And you go back here a little bit, you get it occasionally there. It's either wars or recessions. That's it. And here we are late in a business cycle when we shouldn't have objectively really large deficits. Because it's going to make it harder to get out of the next one. Not that I know when it will be, not that it will be terribly deep, but it'll be harder to get out because we're not going to have the fiscal maneuverability to deficit spend wildly because we're doing it now. We're doing it now gets us insurance over the next 12 to 18 months at the price of what can come down the road later on. Last but not least, on exports, the story is the dollar. And you can see here the dollar hit its recent maximum right below the word R, the letter R in the word stronger. That's when Trump won the election. And ever since then, it's gone straight down. And that's caused manufacturing to take off like a rocket because we can export stuff to foreign countries more cheaply when they buy our currency. Our currency is worth less in euros and yen and renminbi and whatever it is, Australian dollars, so we can export. But because our economy is better, we're importing more stuff, even though it's slightly more expensive. So you put it together. Oh, last but not least, look at this. This is the global economy, the biggest 45 democracies. No one's in recession last year, and no one's in recession now. That's remarkable. It only happens occasionally. It happened in 06 and 07, right? Then, of course, all hell broke loose, but we're not going to talk about that. It only happens about 15, 20% of the time. It's relatively rare. And it doesn't matter. You know, what if, like, I don't know what, Denmark goes into recession? Like, you know, who cares? I mean, it's like 9 people live in Denmark. It's like Rhode Island. You know, it just doesn't matter. But the point is the global economy is really very healthy. So we're having massive fiscal stimulus, inappropriate in my opinion, but that's going to help us in the short run. We have a global economy doing well, so trade's going up, barring some trade problems and trade wars. This is about as good as it gets. This is really as good as it gets. So, how good is GDP? Not great. And you go, how can this be? You've just said everything is excellent And yet GDP is bumping along at these very mediocre rates of about 2.25%. A little better, a little lower, 2.25%. And you go, huh, what the WTF, you know? How can it be? What gives? And the problem is our economy structurally can't grow fast. Why? Our economy's the way GDP grows is only two reasons. You can count those four buckets, CIG and net exports. That's how you count it, accounting. But in terms of the actual what causes the growth, it's only two things. It's increases in people working. That's the blue bar, the bottom blue bar here is blue, right? That's more people entering the labor force. Back to you and the pizzas, miss. So you got a pizza parlor, you hire more people, you make more pizzas. You hire them because you have customers. You used to have 5 people making pizzas, now you have 6. You got 20% growth in your pizzas. The other way to get growth is to get the people who make the pizzas to make more pizzas. If each of your 5 people makes 5 pizzas a day, and now they each make 6 pizzas a day, it's a 20% increase in your pizzas. What if you hired one more person and you got them to make more pizzas? You'd have 40% increase, 20% because of the person and 20% because of the productivity of each of the existing people. That's rocking. You add those up, that's GDP growth. But look at the problem. Our labor force is growing weakly, and our labor productivity growth is weak. Labor growth is weak because population growth is just not very good. It's like, you know, you have to be 18 years old, 16 years old to enter the labor force, right? So it's like, obviously, you know, I don't know, intercourse just wasn't much fun 17 years ago. In 2001, no one was, you know, whatever. We were in a recession. I'm kidding. But the fact is, labor population growth is just weak. It just slows down. So our population is not growing 0.7% really slowly, kind of like that number. And that's all there is to it. Labor productivity is not growing fast because firms haven't invested much until recently in plant and equipment compared to what they did decades ago. I'll show you a slide later. Firms aren't investing in teaching their workers how to do things better because unemployment was high for a long, long time. Since '08, there's been a really surfeit of people around. Unemployment was high. You didn't have to invest in workers. You could say, I want a PhD economist with an MD who's also a lawyer and a surgeon, and I'll pay $12 an hour, and 37 people were there for the job, right? You didn't have to offer them. Now it's a different story. But these two things are low by historic standards. GDP's weak. We're stuck. In the short run, because of the Trump stimulus, we can get faster growth for the next couple of years, 18 and 19. But they can't sustain themselves because we don't have the horsepower in population growth or labor productivity growth, right? And we're not going to have a recession. This is contemporaneous data through March 3rd, so it's like 10 days old. Philadelphia Fed puts it out. Look at this. You have to get to -1 in this series. -1, which is there's a dot here in the middle of 2012 for like an hour. We may have teetered on something resembling the possibility of a recession. It didn't happen, and now we're good to go. There's no problems here. Our sponsor is leaving us right now. Thank you, Realtor.com, the #4 website in the U.S. Go on, say it. It's okay. And more last but not least, we're not going to have a recession because of this. This is the yield curve. The yield curve looks like this. The duration of the borrowing on the bottom, 1 year, 2 years, 3 years, 4 years, 5 years, 10 years, 20 years, 30 years. And interest rates here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you sell a house to somebody, someone buys a house, and you get a 10-year mortgage, rates are like 3%. I'm making it up, but you get a 20-year mortgage, 4%. You get a 30-year mortgage, 5%. Because the longer you borrow for, the more risk that the lender takes. Credit risk, default rate risk, interest rate risk, and some other risk, whatever, right? So long-term rates are more expensive, are higher than short-term rates. But occasionally the yield curve inverts, and short-term rates become more expensive than long-term rates. I know this is weird, but just trust me, it happens. Whenever it happens, the blue squiggle goes above the red bar. And every time the blue squiggle goes above the red bar, you have a recession. Because the gray bar, the gray vertical bar, occurs every time the blue squiggle goes above the red horizontal bar, you have a gray bar in short order, within a year and a half. those gray bars are recession bars. The only exception was 1966, the very first time the blue squiggle goes above the red bar on the graph. And GDP almost went negative. It didn't. It came very close, like 0.5% or something. But there was no technical recession here at all. But since then, it's been a perfect indicator that we're not going to have a recession. It's getting close, but the Fed's not going to raise short-term rates that fast. They're waiting. They're doing it very slowly, in part because they don't want to drive us into the situation. You might say, what's the relationship here? I'll give you just one example of what can happen. As the yield curve flattens, remember, banks lend money. They borrow short, and they lend long. The steeper the slope of this yield curve, the more money banks make making loans. Banks like to make loans. The flatter the yield curve, the less enthusiastic banks are to make loans. So lending sort of stops if the yield curve gets flat and goes negative. You can imagine what happens to the economy. Forget why it happens, but just the mere that it happens causes all kinds of bad stuff. But our economies in the short run fine. Next 12 to 18 months, maybe 24 months, look really quite good. The further out you go, the less certain I am. But 12 to 18, my gosh, I have rarely been more enthusiastic. Let's talk about labor markets. My gosh, labor markets are super, super tight. We haven't had labor markets this tight in 20 years. By some measures, 50 years. That's why the stimulus that we're getting now, won't be as beneficial as it was had it happened, say, 10 years ago when our economy was terrible. Look at this data. This is job growth, year over year, net new job growth. It peaked out at 3 million workers, new jobs, some years ago, and it's been steadily declining, and now it's just above 2 million. This is pretty good given how late we are in the business cycle. We would like it to be higher, but again, the problem is there's no one left. Unemployment is low, right? Unemployment is pretty low, and the people who are available to hire, they're all. And if you run a bus company, it's not going to work out so well, right? So you can't hire these people. So we're just plain running out of workers. How serious is this problem? Well, look at the next graph. In blue is the unemployment rate. It's 4.1%. The last time it was this low, this is the housing boom. This is the dot-com boom. The dot-com boom, it was lower, 3.8 for 1 month. That was the trough, 3.8. Now we're at 4.1. Next month or month after, we hit 4. I'm positive of it. If we get below 3.8, which is likely by the end of the year, no guarantees, but I would pretty much bet my shoes on it, we'll have an unemployment rate that's next lowest to this. This was the late 60s. No one in this room was alive back then. Okay? This is a long time. So our unemployment rate's not quite as low as it was 20 years ago, better than it was 10 years ago, and by the end of the year, probably will be next best to where it was 50 years ago. Another way to measure it is first-time claims for unemployment, the blue line on that axis, on the left-hand side. It's been below 300,000 for 157 weeks. That's the longest period of so little first-time claims for unemployment since, sure enough, back in the late 1960s. Well, what's going on here? Janis Joplin and I were doing acid together in Woodstock or something. I mean, this is crazy. This is a tight labor market. Here's another slide. People say, oh, the unemployment rate's not legitimate because people drop out and this and that. Okay, let's broaden the measure of unemployment we look at. The green is the unemployment rate, 4.1%. And you can compare it to where it was 10 years ago in the housing boom, right here, just to the left of the gray bar, and the dot-com boom to the left of the other gray bar. Today, it's lower than the first, it's lower than in 2008, but not as low as it was in 1999. Fine. Look at the blue one. The blue one's people who work part-time, who want to work full-time, but can't find full-time work. They're looking, but they can't find. And there, the number's not quite so low. Here, the green is lower now than it was 10 years ago, but the blue's higher. So I'm not saying in every measure, our labor markets are as tight as they were 10 or 20 years ago. But generally speaking, these are tight labor markets. This is discouraged workers and marginally attached workers in red. It's pretty much the same as it was then, but not quite as low as it was there. But there's not much difference. That's 1 million workers. It's 1 million workers here. It's like 850,000 workers there. There aren't a lot of workers left here. But here you might pick up, 500,000 workers, 100,000 workers. Maybe there are 700,000, 800,000 workers. That's 0.5%. There's a little further to go. We can go a little bit lower, but there's only so much lower we can get. Look at this next slide. This shows the number of unemployed people divided by the number of available open jobs. At its worst, it was 7 in the very middle of the graph on top, right? That meant there were, for example, 7 million unemployed Americans, and there were 1 million open jobs, vacant jobs, putting out Monster, Career Builder, LinkedIn, whatever, right? Look at it now. It's 1. That means, in theory, there is a job for every single unemployed American. Of course, the people who are unemployed have no skills, and they're staying home and taking fentanyl every afternoon, right? And wrecking their teeth and shooting up between their toes because they don't want to mark up their arm. I know this. I'm just, whatever. I digress. Yeah, prior life, whatever. This is a tight market. So, economy's going fine, not great, but doing well. Next 12 to 18 months are fine. Labor market's getting remarkably tight. Wages should be going up like a rocket, right? These guys are leaving now because they're going to get a new job. I'm kidding. Oh, those are my sponsors. My gosh. Kurt, John, thank you. Wage growth isn't doing so great, surprise. It seems to be drifting up a little, but not nearly as much as you would think. So this is the data. And what's most interesting about this is last month the market went bonkers in early February. We had began to have extreme volatility, right? Why? Because the data point for January was first reported to be up here at 2.9. And the notion was, oh my God, wages are starting to skyrocket. First of all, one data point is almost never meaningful. Sit back and relax. Take it easy. Have a Xanax. Just calm the hell down a little bit. One data point doesn't tell you. And you see it was revised down from here to there. And then the month for February came in even lower. And suddenly now, no one's worried. I mean, that's just manic. You go from, oh my God, to forget about it. No, there seems to be a little bit of drift upwards here, right? Look back 3 or 4 years and you're here in the 2.4, 2.45, and now we're 2.6. It seems to be slowly rising. Not wildly, but it's going up, right? But not much. And it's been kind of flattish. It's going up slowly. Part of the reason we don't have much more wage growth is demographic. There's pure demographics going on. There are old people who are retiring. They're boomers, kind of like, well, you. But on one hand, you're old, but on the other hand, you're very good at what you do. So you sell big homes and make big commissions, and you're keeping 85%. You're telling the brokerage firm, I don't need you, I'll make my own firm, whatever, just give me the money, right? So you're making $1 million a year, but you're on the verge of retirement. And you're going to be replaced in the labor market by you. You're just starting your career, you're 22 years old, you're all excited and fresh, and you're making 30 thou. So you're losing $1 million, you're picking up 30 thou, that mechanically brings down average wages. If you account for that demographic factor, the 2.6, 2.7% wage growth we're seeing now becomes more like 3.2. But interestingly, it's not going up either. Here's a little drift up, a little. Here, not much drift up. So we're not sure if wages are going up or not. They're not going up fast, that's for sure. Part of it's demographic. It goes up by another 0.6 of a point if you clean up for the boomer millennial issue. But this is hardly rapid growth. Why? Oh, first, this is job quitters versus job stayers. This is all people. But if you break the graph in half, or not in 2 parts, people who quit their job, People who stay in their job. Folks who stay in their job are losers. They're on the bottom. They don't get a big wage increase. But if you have the guts and the cojones to leave your job, you make more money. That's the way it works in America. If you want to make more money, you have to give your boss the finger. That's just the way it is. Now, you can tell your boss you have a job offer, or you can lie to your boss and tell them you have one when you don't have one. It's up to you. And then they'll say, oh, we'll match it, or, don't let the door hit you on the way out. Those are the risks you run. But notice the gap. The gap between them is relatively large. This suggests there really is a labor shortage occurring, but yet firms aren't willing to pay much to get workers, which is odd. There are a lot of reasons why this may be the case. A lot. First of all, there's this. This is labor productivity growth. Back to the pizzas. The workers, you beat the workers and tell them the beating will continue until morale improves, right? It doesn't improve because you don't give them any skills. You have old ovens, bad flour, crappy oregano, and exactly, right. So we talked about this earlier. Remember that graph with the blue and the red? The red was labor productivity growth. It's bad. This is indication or proof of it, right? Why? Because firms haven't been investing in plant and equipment. Look at the blue color here. Forget the other colors. It's the blue. So blue is big, and blue keeps shrinking. It goes down, 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 down. Stevie Nicks talked to this. Down, 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 down. Okay. It just keeps going down, and it flattens out. But this is not good. Firms haven't invested in plant and equipment enough. Our workers aren't being all that productive. And the benefits to education are going away. In generations past, more people went to college every year. Lots more people. So you got benefits just from a better educated population. But now, the percentage growth in that's slowing down. But there's other factors too. We can hire workers in Europe to do workers here. We can get our x-rays read in India. Right? There's lots of other ways to go around global supply chains of reduced inflationary pressures. The U.S. is no longer all by itself. There's Europe. There's other countries involved. We can outsource. There's monopoly companies out there. We're an aging society. There's all these things together add up. And as a result of that, this is a complicated graph, but bear with me. It's worth it. If you look back 85, 89, so the dark blue triangles are on the top of the graph. The line of best fit is the dark blue line. That showed that as unemployment went down, going this way, wages went up that way, right? You with me? Then look at the next color graph. I think it's black, right? The slope is the same, but it's lower. But that basically said again, as unemployment gets lower, wages go up. And then since last 10 years, it's virtually flat. It's like something changed. Now, lower unemployment doesn't lead to higher inflation. But the Fed is nervous. The Fed is nervous about that. What if this happens? And we get low enough such that suddenly wage inflation and then total inflation take off like a rocket. It could happen. Anything could happen. But think about something else. Think about unions. Used to have a lot of unions in the country, and union contracts would say, you raise our wages by inflation last year. But now no one's in a union, and people just don't think about inflation anymore. It's no longer automatic inflation. So inflation, overall inflation doesn't lead to wage inflation, which doesn't lead to overall inflation. You don't have this negative circle going on, this vicious cycle going on. So just because you have wage inflation, which we don't seem to be having, doesn't mean you're going to have inflation either. So I'm not sure we're going to have bad inflation, but it seems to be getting a little bit higher. So how about overall inflation? Do we have it? Not much wage inflation. The economy is okay. GDP looks good for the next couple of years. Not much wage inflation. How about overall inflation? Not a lot. Not a lot. Look here. This is import prices. So this is, are we bringing in inflation from foreign countries? Data came out yesterday. Yeah, it's going up a little bit, but hardly something to make yourself nervous about. Worry about other things, worry about your grandkids, your kids, your job, your husband, your spouse, your wife, your girlfriend, your mistress, something. Don't worry about import inflation. It'll go up a bit, dollar weakens, it'll go up, but nothing to matter. How about CPI? This is what you think of as inflation, right? Buying a box of Cheerios, buying an airplane ticket, buying a suit, going on a trip, getting a car. Headline is in blue. It includes food and energy. Red excludes food and energy, called core. Economists like looking at core because it doesn't bounce around. And food and energy bounce around for completely random, independent, non-interesting reasons. Oh, the Iranians take a pot shot at an oil tanker going through the Straits of Hormuz, for example, and oil jumps $10 a barrel. Who cares? I mean, it's meaningful, but it doesn't mean there's inflation here in the U.S., underlying pressures. Similarly, cereal prices could collapse. I don't mean Cheerios, I mean grains. Could collapse if, there's a bumper crop in Manitoba and Saskatchewan, or there's a drought in Australia or something. I mean, it matters in the short run, but again, it doesn't give us indications. The red does. And it's been pretty well behaved. Expectations are going up a little bit, but very little. So the unemployment rate's low, wages aren't going up much, inflation's not going up much, but a little. The Fed doesn't use this measure of inflation. This is the CPI. The Fed uses something called the PCE. It's a little different. It's a better measure. Economists like this measure better. The take-home message is, if we go back to the last measure, between the blue and the red, they straddle 2%. You got it? Blue's above, red's below, 2%. At the PCE, it's about 1.6. Again, red's below, blue's above, in the middle, 1.6. So the PCE inflation's lower, and the Fed uses this measure. They use red. They want the red measure of PCE to be 2%. It hasn't been 2% except for an hour back in 2012, and before that it was 5 years ago. So if we're waiting to hit 2%, we may die. Godot will get here before the inflation does. But it seems to be going up a little. I mean, it seems to even out here, but there's generally a little growth. So inflation's going up a little bit. Wages are going up a little bit. The economy, GDP is okay. Labor markets are tight. What the hell is the Fed going to do? First, inflation expectations. 5 years forward and 10 years forward. You may hear the Fed use words like this. They say things like, inflation expectations are well anchored. That means we don't see inflation taking off like a rocket. And inflation expectations matter. You may think I'm crazy. What do you mean expectations matter? Let me tell you. Think back to 1980. Inflation was crazy then. Paul Volcker became chairman of the Fed. You look like Paul Volcker, by the way. The bald guy there, yeah, behind the old guy. Yeah. Paul Volcker said he's going to crush inflation, right? He told us this. No one believed him. No one believed him. And he drove us into 2 recessions and drove rates up to 18% to convince us he was serious. We had to change our expectations. Japan now is stuck in expectations of no inflation. They have deflation. It just keeps going on and on and on because their expectations are that it will continue. So expectations matter a lot here. Expectations have risen of late, but they've come back down again. They're managed. So nothing is jumping out badly, but there's a little bit of drift in wages and a little bit of drift in overall inflation. What does the Fed do? So this is my graph to show you what the Fed will do, and it's obvious. It's easy and it's obvious. What this shows is the taller the person who runs the Fed, the higher the interest rates. I mean, what am I going to... I don't make this up. I'm an economist, man. I've got your back. But Paul Volcker was 6'8", and Janet Yellen's 5'3". And as they shrunk, rates came down. He was a mistake. He's too tall. Had they asked me, would you be central banker? I would say no. I love the economy too much to force my 6 foot body on the overall economy. It'll cause inflation to rise. Now, he is a mistake, but that's a whole separate issue. He's a mistake because, this sounds pompous, he's not an economist. He doesn't have enough understanding of the system. It took Yellen and Bernanke strong perseverance to resist raising rates. It took Greenspan back in the 90s strong moral fortitude and moral suasion not to raise rates and force others to let him not raise rates. I don't think he has the strength to do that. So the fear is he might just raise rates just because it's the path of least resistance. And if he does it, the chances of bringing on a recession go up. Not this year, but next year. Do I think it will happen? No. Is he a smart guy? Yes. But he's just a stupid lawyer. It's not his fault. He's born that way. It's nothing he can do about it. I mean, I'm kidding here, but he will be captured by his staff, who's all economists. He'll be captured by other central bankers. And central bankers live to raise rates. They see inflation lurking everywhere. At night, they're nervous. Not the boogeyman, the inflationary pressure man will show up, or woman, or whatever. That being said, this is what I think happens. Fed funds rates right now there. I think by the end of the year, they raise rates 3 times, including this week or next week when the Fed meets. They bump it up a quarter point, 25 basis points. Next year, they raise 3 times this year, twice next year. But it wouldn't shock me if they raise them 4 times this year and twice, or 3 times and 3 times. And you get closer to 2.875 by the end of 19. It's entirely possible. I would not put it out of the question. And it depends on how fast GDP growth is and how fast inflation. They both go up a little bit. They're going to raise a 4th time this year or a 3rd time next year. But that's about it. You're not going to get high interest rates at the Fed funds level or the 10-year Treasury, off of which 30-year mortgages are based, because GDP can't go up fast. Remember those 2 graphs, the blue line and the red line? That's the max GDP can do. The only way you can get rates higher than that is if inflation starts to take off. And the Fed's already raising rates now. Because the Fed's raising rates now, expectations are that there won't be inflation in the future, 5 and 10 years down the road, because they're already raising it now. If you raise it now, you're slowing down the economy, preventing the inflation from building, such that in 5 years, you won't have a problem, or 2 years even, you won't have a problem. So they're already reducing inflation expectations by raising rates 3 or 4 times this year and 2 or 3 times next year. So it's hard to see inflation going high. It's hard to see GDP growth going up much. That's why we're stuck with very low Fed funds rates and relatively low interest rates. As you can see here, last week or 2 weeks ago, the 10-year Treasury hit 2.99 or 2.97, right? I don't think it goes above 3.1 this year because we're just not going to have enough inflation and not enough growth. We may get a little more growth next year, a little more inflation next year that may bring it a little higher, but there's not going to go up much in the long haul here. We can't get there, right? Now, let's talk about housing. What the hell is going on in the housing market? How do we find ourselves in the soup that we're in? Well, let's look at the good news first. There's not much, but we'll dwell on it briefly. I'm kidding. Red is dollars spent in construction. And you can see the number's pretty good. It's as high as it was in 2004, roughly, right? Roughly 2004, mid-2004. That's not bad. It was a good year. Built a lot of homes. How many homes did we build? This is 1990, 2001, 2, 3, 4. So 3rd from the left is 2004. And that's 2016. 2016, 2004. There's a couple of things going on. Inflation in 10 years has reduced the price. The dollars are worth less. Yeah?
Are you talking about just single family?
Yeah.
Or all
Single. Multi hasn't changed much. There's not much of a story there. We'll get there soon. Right? Secondly, the percentage of homes that are big, above 2,400 square feet, gray, black, and this blue, are here. Over 50% of the homes built in 16 were above 2,400 square feet. If you go back to 2014, it's more like 35, 40%. So there's inflation, and they're building bigger homes. The miserable, rotten, stinking builders are building bigger homes because they can't make any money building small homes. If they could, they would. Trust me, they would love to. Listen, you could sell them, they would build them. But they can't build them and make any money, so you can't sell them, and we're short homes. Look at this example. This is painful. If you look back 10 years ago, 12 years ago, 2005, the cheapest homes, under $150,000 in light gray, $25,000 a month. And the next cheapest houses, between $150,000 and $200,000 in black. Each $50,000 a month. Now, it's about $6,000 a month. They've fallen by 90%. That's crazy. Okay, Portland's expensive. You've had lots of inflation in house prices, I know. But you get the point. No cheap homes are being built. And because not enough cheap homes are being built, we're not building enough homes. Because you only can build so many homes if they're really expensive. Bill Gates only needs a few houses, and you're done. This is the average home price before the recession. Then comes the recession. And look where we are now compared to then. This is the median price before and now. These are crazy increases in home prices. There's not enough homes being built, yet we're creating 2 million jobs, 2.2. A couple of years ago, 3 million jobs. We need more homes. But the builders can't build more homes and make any money. Why? Regulation. Oh, in Oregon, it's impossible to get land. You have the development bagel thing here. That's the stupidest thing I've ever heard. But be that as it may, it's a conversation for tomorrow. Because there's no land. Oh, you can't build high because it wrecks the view. You can't build near water. You can't build near a street. You can't build near a road. You can't build much. And therefore, you don't build. And therefore, prices keep going up. And you end up building in Clark. We'll get there. We'll show where they build. Regulations are bad. Labor productivity in construction over the last 70 years has been 0. So any labor you're putting into a house is getting more and more expensive because the workers aren't any more productive now than they were 70 years ago. The only improvement in building a home has been a pneumatic drill. Wow. Wow, that's big. Whoa. Labor input costs are skyrocketing. Trump just a year ago raised softwood lumber imports from BC, Western Canada, driving prices. And now the aluminum and steel tariffs are going to drive the price of steel and aluminum up, raising costs even more. And there's no workers. So builders look at this and they say, look, we've got a problem. No workers, input costs are expensive, labor costs are expensive. You can't get land. We'll just build expensive homes and be done with it. You can't afford them. Not our problem. We're not going to build them. So we're chronically underbuilding homes. We should be building many more homes than we are. Making matters worse, there's miserable foreigners who are buying houses here. And I joke, we like foreigners. We want them to buy our homes. We want them to buy our bonds. We want them to buy and move to America, right? We want foreigners. But they're adding to the shortage of homes. Foreigners are buying homes in Portland because they got priced out of Vancouver. They moved to Seattle. They got priced out of Seattle. They're now moving to Portland. You are the cheapest city on the West Coast. So won't move to Portland. It's not that they love you. It's that you're cheap. You know, keep that in mind. Remember that. This is through 15. If you look at 17, they've gone up. Foreigners are buying more homes. The Chinese want to get out because everybody ends up in jail who has any money there and so on, right? This is the problem. Not enough new homes. Blue, miss, is multifam. And multifam is kind of peaked out because demographically, nationally, demographically, the millennials are getting old enough. They're getting to be 20, 25. The oldest ones are 37, 38, and they're buying homes. Now, in Portland, it's different because your market's bizarre in Portland. You don't build any single. You have to build a lot of multi. But generally speaking, the multifam party's completely over, and you can see it's declining. Banks aren't lending against multifam anymore. It's done. Demographics have changed. As demographics were favorable towards multifam until recently, now they're changing and moving towards single fam. It's the red that's the problem. We should be building easily 1.2 million single fam units. And we're at 850,000. And this year will grow by what, 4%? Are you joking? That's ridiculous. We need 300,000 more homes. We're underbuilt by 3.5 million homes. And this year we're going to be underbuilt by 200,000 more. So we're making the situation actually worse. This is crazy. And there's nothing we can do about it. Unless we get the builders to build more, and they can't, this problem persists. Something's got to give here. We'll talk about that in a couple of seconds. But this is the result. Foreigners want our homes. Builders don't buy enough homes. We're creating good jobs, over 2 million jobs a year. Wages are going up a bit, and inventory has shrunk year over year for 32 straight months. There's nothing to buy. If you want to get a listing, you have to either chase an ambulance or go to a funeral parlor. There's nothing to do. There's not, and people like me who I live in just outside DC in Chevy Chase. I want to sell my house and move downtown. So every week my realtor gives me the listings that are available. One listing, it's gone in 13 minutes. So I've given up. I'm going to sell my house and move to Miami. At least taxes are low in Miami. Maybe hotter than hell in May, June, July, August, September, but whatever, I'll buy another place somewhere else. But I've given up looking. That means my house isn't going to, maybe I'll rent my house. I have a super low mortgage. So I won't even let my house go on the market you get these home improvements, house off the market, people who have low mortgage rates, they're not selling their house, nothing to buy. Builders aren't building enough. This is the outcome. This is the intersection of all the problems that are out there. And we can't overcome this. So something's got to give. But look at this first. This is increases in prices nationally. Portland is worse. But nationally, prices are going up at 6%. I told you earlier inflation is roughly 2%. Wage growth, if you will correct for demographics, is 3%. And now house price inflation nationally is 6%. It's unsustainable. House prices can't go up twice as fast as wages. They just can't, right? Something's not right here. So if something's unsustainable, it will stop. How will it stop? Well, interest rate rises are going to help us to get that point. No question about it, right? First, there's no bubble. I talked about this earlier. I said 10 years ago, 12 years ago, the housing boom, there was just credit for anybody. They had, what they call it, ninja loans. No income, no job, no problem. It's fine. We'll lend you money, sure. House prices never decline. Don't worry about it. Trust me, I know that. But you can see here, there's been almost no deterioration in FICO. Since 2014, there's been no. This is the 50th percentile, the bottom 25th, and the bottom 10%. There's been no decline in FICO score. So there's no real problem here. Are banks doing a bad job? No. They're rationing, providing credit in a reasonably appropriate fashion. I'm a little concerned about the non-bank banks, non-lenders who are not banks, like Quicken. Maybe there's a problem. Not Quicken, for example, I don't know. But there's some research out there suggesting non-bank lending is a bit of a problem. But, we're okay so far. This is multifam again, miss. And multifam shows this is good for landlords on top, good for tenants on the bottom. It's going straight down. Again, Portland is different because you're so tight in construction because of the urban growth boundary problem you've got. And in Washington State, they've got problems as well. They got problems there as well, all right? Now, let's quickly talk about tax reform because it matters to Portland. There's an interesting side tip here. First, to get the tax reform, as you know, changed the value of a house a little bit. It made houses a little less valuable that are relatively expensive. If you don't itemize, it doesn't matter because now almost no one's going to itemize. We'll have a reduction 2/3 from 45 million households to about 15 million to itemize because the standard deduction's higher. We can talk during Q&A or afterwards about this. But if you buy a house that costs like $600,000, $700,000, $800,000, that's where tax reform really hits hard. It reduces the value of your deductions quite a lot. So to see how much impact it has, you need 3 things. We're going to look at 3 things. Your house prices. So Oregon here, 2%. Among the more expensive states, Washington, Oregon, California, a little bit here in the mountains, and then the East Coast. Forget Hawaii, who cares? Doesn't matter. You have here and you have here, right? So you're relatively, not high, but you're relatively 2% compared to the worthless Midwest. I mean, this is just flyover infrastructure for American Airlines here, right? But anyways, you have higher house prices. Washington has higher because Seattle's bigger. It's a bigger city, more expensive homes. That's what's driving the boat there. Next, you have to have high property taxes. You don't have terribly high property taxes in Washington, so Clark County, or in Portland. Right? They're pretty much average, 24th and 23rd nationally. Your house prices are a little high, but your property taxes are pretty average. This means this is the size of the average mortgage interest deduction taken. It's a little high because your house prices were a little high, right? You go back to here, these 2 states, and those were the top 10, so not surprisingly, you're 9 and 11. That makes sense. Now, let's go to the next slide. How about income tax rates? If you have high house prices, high income taxes, and high property taxes, that's New Jersey or Chicago, and you're screwed, okay? You here have relatively high income taxes at 10%, all right? Relatively high. And the problem you face here is that Clark County has no income taxes. So I think what happens here, and I was in Clark a couple days ago, is that people given a choice who can move. If you work in Multnomah County, even if you live in Clark, you're still paying income taxes to Oregon. You can't just skip out of town and save your taxes. But if you're self-employed or your firm has an office in Clark, in Vancouver, hey, I'd like to move. I could save a lot of money because I can't deduct my income taxes anymore. Essentially, you can, but it's harder now because the standard's higher and so on and so forth. So this differential between 0 and 10 is extreme, and Vancouver's a viable town. I know you may think only idiots live there. What do they call it? Vantucky or something? I've heard about that. Yeah. There's Portlandia versus Vantucky. Yeah. I understand there's real animosity between these two states. I'm a foreigner. What do I care? But if you look on the map, you don't see this differential that much. It's very rare. Pennsylvania and New York is a bit of an issue, and people from Western New York are moving into Pennsylvania in droves. They were already doing that before. This will just drive them further into PA, right? You've got Illinois. There's some Illinois stuff, Wisconsin stuff, whatever, but this is a pretty stark one. So keep this in mind. There'll be a little bit of desire to move to Clark from here in Multnomah, Clackamas, Yamhill, whatever. I'm not sure the geography here exactly, but you get the point. That's the key thing here. So keep this in mind. And last but not least, here's a map. And the map, the darker the green, the more the trouble. And here it's very clear. You can see that in Oregon, there's a little bit darker green than there is just across the border. Here, it's much lighter than it. Okay, in Seattle, you got problems again. But just across the border, you don't have problems because the home prices are cheaper and the income taxes are lower. So I think there'll be a couple thousand people a year move from here to there. I'm not talking torrential amounts of people, no. But, someone like me, for example, if I lived here in Multnomah, I'd be moving to Clark. I don't care where I live, just cross the border. Get an Uber for $10, you cross the bridge. Big deal. Now, people here, they're screwed. They're screwed. This is the Silicon Valley, San Francisco, and Los Angeles. It's pretty expensive. And parts of Texas, they have no income taxes, which will help them, but very high property taxes, right? And then, Connecticut, New Jersey, New York City, just outside New York, Fairfield, Connecticut, parts of Massachusetts. New Hampshire is quite high. Again, no income taxes, but very high prop taxes. So it's mitigated because people from Massachusetts will move to New Hampshire to avoid some taxes. In terms of refi activity for lenders in the room, if you live on refi, just commit suicide. You can see the amount of volume just continues to decline as rates go up. Now, before we close out, let's talk about this, what will happen because house prices are going up too fast. This is the first sign of something going wrong. Year-over-year increases in first-time mortgage apps are pretty much flat. You can look here the last year. There's nothing really going on here because houses are too expensive. There's nothing to buy. They aren't even too expensive. People can afford it, but there's nothing to buy. There's nothing around to get. If you can't get it, you can't buy it. So what happens? People will live in apartments longer. They'll live with roommates longer. More people have to live in the existing space. And to do that, it's going to require having roommates for more years. So after college, you live with 4 roommates, not 2. You live with 4 roommates for 4 years, not 2 years. Then you go to 2 roommates, and then you finally get your own apartment, and it's a smaller one. That's how we can use land more intensively to compensate for this lack of home construction, right? Here's another way we can look at it. This is existing home sales. So this is where you guys make the bulk of your money. Some of you sell new homes, but there are almost none of those around, so who really cares? I'm kidding. And you can see they pleasantly rise since the end of the recession. This is through 15. Let's bring it forward. Early 16, this is actually 14, 15, mid 16, and then it stops. There's no growth. There's no growth. The only way you're making more money now is because your prices of the homes are higher, but you're not selling more units. That will continue this year because the inventory shortage is acute and will remain, but prices will go up by maybe not 9 or 10. That's just ridiculous, but certainly 5 or 6 or 7. So you'll make more money this year on no more work. It's kind of not bad, actually. More money, no more sales. I kind of like that, like you charging more for the pizza. You'd like a little more pizza sales too, but if you got to have one, better to have higher priced pizza than cheaper pizza, more pizzas, So this could be worse, but this is a problem. And here's another one, pending home sales. The line is 0. So that's great. That's big recovery. Nice. This is really good. This is generally very good. This is not so generally good. So conditions have slowly weakened because home prices are high, inventories are low. There's no magic here. I wish I could say there's going to be 5,000 more homes in inventory. And this is across the country. You're not special here in Portland, Vancouver. This is everywhere in the country. Los Angeles, Pittsburgh, and New Orleans. It makes Fort Wayne, Syracuse, and Detroit. Everybody has the same problem going on, right? And last but not least, there's going to be relentless demographic pressures coming because the millennials, who are between ages of 19 or 20 and 37 or 38. So these guys have already bought a home. And now these guys are getting close to buying a home. So we're young enough to want to buy a home. We're creating jobs. We're not building homes. This is something weird here. So focus on this. Keep this in mind as you go forward. But don't forget about the boomers. The boomers are old, like you. But, like you, you're in good health and you have lots of money. And your average expected life expectancy is huge. You're going to live a long time and be healthy and maybe buy another home or two or change your housing arrangements because you want to live downtown, near a mountain, do hiking and biking. You have to cater to the boomers. Absolutely. Cater to these guys and those. I'm born right here. No one cares about us. It's the valley of procreative death. There's all these guys and those guys and we guys in the middle. Yeah, to hell with them. Okay, fine, whatever. I'm not bitter. And last but not least, because of these pressures of here, we see home ownership rates going up. Now, the tax reform is going to reduce home ownership a little. Whatever it would have been absent the tax reform, it's going to be a little lower. But it's still going way up because the demographics are going to push it up. But there'll be a few of these people who would say, I would have bought a home if I had the mortgage interest deduction, but because I probably can't get it, I'm not going to buy a home, I'll live in an apartment or buy a cheaper place instead. You'll get some substitution where it's cheaper and a little bit less owner, a little more renter. But for the foreseeable future, this is still going to go up. It's going to end up being a little lower than it would have been otherwise. This graph shows you, again, the single-fam construction problem. Look at the blue. The blue is single-fam. And you can see how high it was here, how high it's generally been, and where it is right now. The level it is right now is at the level it was last in 1982. That's a long time ago. Our country was much smaller back then. Repairs are in red. They're pretty much recovered. Broker commissions in dark blue are decent. They're back at the level of 2000 roughly. They're okay. And then there's multifam and other stuff. But the single fam is really the problem. If you see more single fam being built, that would tell you we're going to be okay. Inventories will rise and house price pressure of appreciation will go down a bit. I got 5 more minutes. You want me to go or you want to stop? Go. Okay, we're going. There's lunch. They're serving marijuana. You get a free little bag, a little bud with every meal. First 100 get it. You're missing out here. For those of you who don't know where you live, there's a red arrow over Washington and Oregon. I know I'm in Oregon. I know that. But Clark being so close in Vancouver, it's important to keep them in mind, especially given this this income tax issue that's important. So this is contemporaneous data. Things are fine. There's no problems out there. This is leading economic indicators. They're fine. You're both good states. The problem you guys face is if there's a trade war with China, that could be very bad. If Washington State, if the Chinese slap a tax on Boeing or the Europeans slap a tax on Boeing, that would really wreak havoc with Washington State. It would filter through to Vancouver a little bit. I mean, they're making this fuselages up in Seattle, I know, but you get the idea. You do a lot of trade because geographically you're Asia. On the East Coast, it's Europe. They could slap tariffs on stuff too. So we live in fear on the East Coast of different slapping tariffs, but the same potential problem. But aside of that, we're fine. Do not go to Montana. Stay in Idaho. Just skip around. Go to Cheyenne, Cody, and then back up and you're fine, okay? Just no driving through on I-90. Just don't do it. Or I-80 or whatever the freeways are up there. In terms of unemployment, you're pretty average. Oregon's just about dead average. Washington's a little higher, but within the realm. Only 2 or 3 states have elevated rates above 5%. And even that's, by historical standards, remarkably low. Everybody's doing well here. Even these weaker states like Alaska, this is, okay, they're 7.5, but you hear 5.8 in New Mexico. I mean, come on. These are great rates by historic standards, right? In terms of unemployment rates, this is the story here. I look at the 4 biggest counties in the metro area. I didn't look at Yamhill, they're just too small. And what you see here is the 3 Oregon counties all travel together, with Clark being higher. So Clark is clearly less economically vibrant. It's obvious. I'm not telling you something you don't know. But they're doing well too. They're at 5. That's by historical standards, a very low level of unemployment. No problem. In terms of job growth, Clark did much poorly. This is below here is negative. So for a long time, Clark was losing labor force. Elsewhere, it was much more brief period of labor loss here, and there a little bit. So the Oregon counties did better. It's taken Washington County, Clark County in Washington longer to recover, and they just did it a little over a year ago. The other 3 counties recovered much more quickly, right? If we look here at housing prices, there's no magic here. This is what you know, but we're going to show some interesting things here. So clearly, Multnomah is the most expensive area. It includes downtown Portland, right? Clark is the weakest, but not much different than Clackamas in Washington, right? So it's Multnomah and then everybody else. But Multnomah's driving the boat because price appreciation, the houses are more expensive and they're growing a little bit faster, right? So if you look here at housing prices, and this is in the Northwest, so we're comparing now Portland, essentially, this is all Portland, to Seattle and Boise. They're all doing well. Maybe we're starting to see some slowing down in house price appreciation here. Maybe not. Maybe yes, possible. This is end of 17, late 17 Q3 data, possibly. This is income growth. It's good in all places, but again, Multnomah's the star. House prices are highest here. Incomes are highest here. And last but not least, there's no friggin' home construction in Multnomah. They're building in Clark, but they're not building in Multnomah. So Multnomah's expensive and house prices and high incomes, but the no good nicks in Multnomah won't build any houses. So Multnomah folks have to move. Someone's got to move to Clark, and it's the Multnomah folks a little bit who move to Clark. And Clark is your safety valve, your release valve. Things would be much worse. They've almost brought themselves back to where they were before. By contrast, Multnomah is lower and was roughly the same level as Clark before the recession. So you're not building enough in Multnomah, and that's exacerbating the problem. How to fix that, that's a whole separate problem. Last but not least, in terms of migration, you live in a great corner of the country. Of the 4 most popular states to move to, 3 are in the Northwest. Washington, Oregon, Idaho, and number 1, Vermont. Bernie Sanders is bringing them home. What can I tell you? I don't know. But so this is another problem. You need to build more homes because not only is your population going burst over deaths and it's an immigration, but there's in-migration from the other 49 or 47 states, right? 48. Vermont's not coming here, and neither is Oregon, and, Washington, and Idaho. But these are, Nevada's also popular. No income tax there, right? So you got no income taxes there and there. Oregon's really weird. I mean, it's hard to move to northern Nevada. There's nothing there. It's either, this is Vegas and that's Reno, right? There's no other place to live in the whole state that's empty. Elko, I mean, so you have, it's an odd thing. Oregon's bracketed by 2 zero income tax states. Think about this as you go forward. And last but not least, this is population growth. So not only is there immigration, but population. This is the U.S. in black here. Every county, all 4. Look at Clark. Clark is now number 1 again. They were number 1 for a while. They're number 1. But everyone's doing roughly this number here, whichever county that is, that's Multnomah here, is twice as big as the U.S. average. So there's unrelenting population growth coming here, and high incomes, and not enough homes. What can I tell you? Whoa, we've covered a lot of territory. Let's review quickly. First, this is my name, my cell number, website, email address, and Twitter handle. I put out 70 words every day on economics. No graphs, no ads, no charts, no links, no photos, no self-promotion. Give me your business card, you'll get it. Go to my website and sign up, you'll get it. Or text the word bowtie with no hyphen and no space to the 5-digit number 22828. You'll be then prompted for an email address, and you'll hear from me every day until you die. So think hard. The economy is fine for the next 12 to 18 months. It would take a meteor shower or something like that to wreck our economy because of all the stimulus coming. And the globe is doing very well, too. Labor markets are tight. Wages seem to be going up a little. Inflation's going up a little. The Fed will raise rates at least 3 times, each of a quarter point, and possibly a 4th time. And the problem you have here in Portland metro area is the same as it is everywhere. You simply are not building enough homes. You got to build more homes, and you got to build more lower price homes. I'm not saying cheap homes. I'm saying entry-level homes. Whatever that price is, it's different in Los Angeles than it is here, than it is in Fort Wayne. But in all these cities, they can't build it. That's the problem. Everyone's suffering. Californians move here. You're moving to Sacramento to avoid the problem. You're going somewhere. Boise's becoming hot because it's affordable. On the East Coast, you're going to Charlotte and Atlanta and Nashville because it's affordable. I hope I've given you food for thought. I hope I've given you something to think about. We have hopefully time for some Q&A. And then I'll be hanging out here answering questions one-on-one. Thank you to Realtor.com for sponsoring me. Thank you, you guys, for bringing me in. And for all of you for coming, I look forward to seeing you again at some future venture. Thank you, thank you, thank you.
Real quick, folks, we have plenty of tickets for complimentary lunch. You can grab one right outside the door here as you exit the room today. If you don't have one in the... Okay, all right. We're good.
Please.
It's totally different than anything. No, don't make me.
They can't hear you. They can't hear you. Your question is brilliant.
I don't know. You haven't heard it yet. You didn't talk about where China's going compared to where we're going. And also, are we going to be left behind not investing in a lot of AI in our investment?
All right, so China and AI. So AI, we need AI desperately. Our population growth is very meager. We talked about that earlier. And labor productivity is weak. And we're getting older. So Medicare, Medicaid, and Social Security costs are going to go up. We need to get labor productivity up to produce goods and services for us as we age. That the ratio of people who are working to not working, we need to get those working people to be able to produce tons of stuff. So we need more AI, we need more robots, we need robotics, we need everything we can think of, and we need it in healthcare, education, and construction especially. Those are the least industries that have in growth and efficiency has been very meager, relatively speaking. And we also, to compensate, we have to increase education skills for people. No high school dropouts. We can't afford high school dropouts, especially among boys. Girls seem to do much better getting vocational training or bachelor's degrees now. Women are outperforming men. It's the boys who are doing particularly badly. That's number one. In terms of China, China will continue to grow faster than we will. They're at a lower level of development than we were. Average incomes are lower. But it will continue to slow. Because as they get bigger, you only can grow so fast. You know, pizza, you have 5 people, you grow 1, it's 20%. You have 20 people, you grow 1, it's only 5% growth. So as you get bigger, you go slower. The problem with China is I don't believe any of the data that comes out. They lie about everything. They don't mean to lie, it's just what they do. It's a authoritarian country, not totalitarian. So it's hard to know. You look at like electricity consumption, steel produced, or shipping containers that move, some real data, but even that they lie on. It's hard to know. But they're going to slow down. And the thing we have to avoid with China is having China have a recession of some kind. That would be very harmful to us. But unfortunately, it's hard to know what's really happening there. Their debt levels are too high. So at night, if I can't sleep, I occasionally perseverate about China. Not wildly, but it's not easy to become a developed country from an underdeveloped country. They're making progress, but they don't all make it. It's risk, and the fact that now Xi Jinping has become leader for life, essentially, makes me more nervous that the higher likelihoods of mistakes occur because there's less competition for ideas than there was. There wasn't a lot. Now there's even less. I'm a little more nervous about it, but not overly nervous.
I'm interested in knowing how the things that you talked about are going to impact vacation home sales.
Wow, vacation home sales are going to be, it depends where, but vacation home sales are generally driven by the stock market and income growth. The upper class, I don't have any slides here on that, but the upper classes are doing spectacularly well. This stock market growth, this wealth growth I talked about in my second slide, from 55 trillion to 100 trillion bucks. a lot of it's going to the very upper income people. Poor people, the bottom half of the income class, they're not getting a lot. They don't own a lot of stock. Many of them don't own a home and so on. So the upper classes are getting it. Their incomes are doing well because of changes in tax policy and just geopolitical things that have changed. The returns to education, high levels of education have gone up, and the returns to capital have gone up. So if you own stock and bonds, you've done stock especially, you've done very well, or own physical assets, you've done well. So as long as the stock market's good and income growth is good, it's going to continue. And moreover, if you're looking at a place like Bend, for example, or something, which is a prime resort area in Oregon, right? What? And the coast, yeah, the coast, or not Coos Bay, but other places there, Jacksonville or whatever. Coos is kind of depressed, but there it's going to depend a lot on house prices in the metro areas nearby. So Seattle, Portland, and California. And if those prices continue to do well, that'll be the pipeline. People will be able to tap that house or sell that house and retire somewhere on the Oregon coast and play golf all day. So it's income, stock market, and house prices in the nearby metro areas that people are going to emigrate to or begin to plan to retire to from. Sir?
Thanks for being here on it. A lot of our economic success now seems to be based on spending. You mentioned people going to Vegas, buying cars, bow ties, whatever they're buying. My question is, with over 40% of Americans having less than $10,000 saved for retirement, what are the long-term impacts? I mean, interest rates being low gives very little incentive for saving. How do you see that affecting us more long-term than short-term?
Okay, savings rates have been declining of late. House prices have gone bonkers. And when house prices go bonkers, savings rates collapse. Savings rates 2-3%. These are very low rates. I think the way to think about this, though, is more general. Yeah, it's true 30 or 40% of Americans don't have $500 to have a car repaired or buy a pair of tires for a car if they get slashed or something. But that's always been the case. And now we still have that problem, but we have good things elsewhere in the economy. What we have to do for that group of people is give them a chance at good education. That's what we owe them, right? And I'm getting older now. I'm a little more philosophical, a little more less dogmatic than I used to be, and so on. But you got to give people a chance to achieve whatever it is they can achieve. And if they're stymied by crappy grammar schools and crappy high schools, they're never going to get to college or a vocational school and get a good career, be it as a plumber or electrician or an economist. It doesn't really matter. You want people to achieve. We need them to achieve. It's in our best interests to help them achieve. How can we get kids in grade 10 who are disaffected, essentially, who want to drop out, to stay and become a journeyman electrician or something? We need to do that desperately. And there are policies we can follow that will do it, but on Washington, D.C., there seems to be very little political will. It's a long-term problem. No one gets credit for solving the problem because it takes 5 or 10 or 15 years to go there. But that being said, it's something that desperately, desperately needs to be done. And we need to convince people you don't have to go to a four-year college. Four-year college isn't for everybody. It was for me because I have no skills. I can tell jokes. I know a little economics, but I can't turn a light bulb on, right? Other people don't like school, but they're great at doing stuff, and they learn by doing. And everyone should be encouraged to get as much education as they can. More robots, more education, and hopefully that will help. But that's the only real solution. You can do tax reform to help the lower incomes, and if we go that route, the way to do it is through the low-income housing, the earned income tax credit. And the earned income tax credit basically says if you work full-time and you make less than this, we'll bump your pay up to that because you work hard and we value work in our society. Don't force the employer to pay them more money. Don't jack up minimum wages because that burdens the employer and that gives the employer incentive to invest in plants and equipment and more AI and robots. They're going to do it anyways. Don't encourage them. But if you work, we will guarantee you $20,000 or $25,000 a year or whatever the math works out. We need to do everything we can to encourage work. We want everybody to die on the job because our population growth isn't big enough, right? To compensate, we need people who are older to stay in, people who are in to work more.
What about going on that topic? How do you see the government helping with student loan debt if that's such a problem?
Whoa. Okay. Student loans are very high. Student loans average per capita like $3,500 or $4,000. I am not, this is personally, so we're getting off topic here a bit. I'm not a big fan of giving students off on their money beforehand. All right? You go and you work 10 years at a nonprofit and we'll knock your debt off or something stupid. That's just crazy. That's just wrong. The private sector creates jobs. You want to encourage people to work in the private sector. You want to work in the government? That's great. Go there. But you don't get special treatments as a result. That's just wrong. But what we could do, I think, which would be better, it's never going to happen, is say, hey, if you finish your degree and you get a good job, we can knock 5 or 10% off of your student loans. The faster you get there, the better more money you make or something. Give them some incentive to get out and get a job, and we'll help you a little bit. Bernie Sanders' idea of free student loans, that's just horrible. No college price, that's horrible. Australia's tried this. We've copied Australia. And Australia has now got a fiscal disaster on their hands on student loans. And they're drastically pulling back on them because they realize this is a road to hell. So what we should do is, there are things we can do to help. Keep 2-year colleges affordable. People go to 2-year college and transfer their credits to a 4-year college. That's a great thing. Make sure all your credits are transferable somewhere valuable. Don't make you have to keep retaking classes and taking more courses. That's completely wrong. And keep community college affordable. That's the other thing. So you can get at least 2 years out of your 4 years without paying a lot of money to go. And there are other, I don't know the system here, but in California there's the Cal State system and there's the UC system and different prices at different places. Give people chances to go for not a high price. Going to high-priced fancy schools, be it in Corvallis or wherever, right? This is not always the right solution. These may not be optimal solutions here. So college is expensive. We should figure out ways to get the price. College, believe it or not, the appreciation rates in college costs are going down. So every year the growth is slowing down quite a lot, but they're still very, very expensive. Yeah, that wasn't a great answer. I did my best.
What have you seen that has helped the most in allowing builders to build more affordable, smaller houses?
Geez, it's higher densities, the biggest thing you can do. People are offended. A builder says, I'll build an 800 square foot house or 1,000. Oh my God, that's horrible. Why is it horrible? In Manhattan, people live in 200 square foot apartments. I think that's crazy, but who am I to tell you how to live? The code should be for safety, should be for protection, and should be for durability and quality of home construction.
And you were saying that they didn't make any money building that stuff.
Right, but the thing is, you have to figure a way to let the builder do it. Smaller setbacks on left and right and front and back. Maybe no driveways, maybe no sidewalks, whatever it takes. But get a home that people want, that's attractive, that has curb appeal, that is nice, doesn't give up any quality, or not much, but just gives up a lot of space. Hey, I was here in Portland 4 or 5 years ago and stayed for 4 or 5 days in a 350 square foot house. There were 2 of them next to, I'm not sure what part of town it was. It was very cool. I managed. If that's all I could afford, I would gladly buy it. But they won't zone it. People won't zone it. They want all these fancy things. Oh, it has to be pretty. It has to have different setback. Every house can't look the same. I was born and raised in Montreal. I lived in a monotonous house. And no wonder I'm mentally unstable. I didn't know I lived in a monotonous house, but that's why I'm monotonous. But you get the point. The codes have to accommodate some changes. The fire codes add $5,000, $10,000 to the price of a house. But the homes that they're building today have all these other features in them. Houses don't burn down. Firemen don't put out fires. They do EMT work now, which is important, don't get me wrong. But if you're going to have fire codes, you don't need the other codes. If you have the codes, you don't need the fire sprinklers. But you have everything. We're overbuilding. We're overbuilding us. We're buying insurance for everything. And rich people buy insurance. Poor people go to war. We don't need so much insurance here. We're over-insured, essentially, on our house quality. We can get rid of some of the codes, but good luck. Good luck.
What do you think of the, looks like Dodd-Frank's going to be rolled back. What do you think of that? How do you think that changes your economy?
In the short run, not much. The Dodd-Frank changes are generally okay. I'm not wildly concerned that letting up on those banks between $50 billion and $250 billion, giving them an easier time is going to drastically change the world. Those banks aren't big enough to wreck our economy. It's the $1 trillion plus banks that really matter, and they're still going to be in there. They have to stay in there and make sure they pass the stress tests. My fear is more that we don't know what the next recession is going to be caused by necessarily. It could be interest rates, and that's just a good old classical recession. Fed raises rates too fast, drives us into the drink. Okay, we got to do that. But, there was a dot-com boom. It's the housing boom. You know, will the next one be some other frothy market that we didn't think about that gets created in some weird way? That's more my concern. Because we're always fighting, of course, the past war because we can't then think about what's going to happen next. So the relaxing of Dodd-Frank makes me slightly nervous on that score. Tighter, more solid banks are better than not. But in the short run, not, and generally not.
What do you see with the AI taking over so many jobs in terms of the future Social Security reserve? And then there's other country actually adopt a different approach in terms of Social Security income. They like give you like they give like Scandinavian.
Oh, they're giving you a base income. I forgot the word for it.
Working or not working because there's so many jobs going to take over by AI.
All right, so I'm not so concerned about AI taking over jobs. Every time we've had a revolution of some kind, be it the agrarian revolution or the industrial revolution, we've somehow managed, we are humans, and we always want more. More is always better. I need bigger drawers, bigger house, bigger waistline, bigger car. Give me more. So we will be able to consume more. Moreover, our economy is largely service-based. You want a haircut? A robot can't do it. You want a massage? A robot can't do it. You want to hear a string quartet? Well, you need 4 people. There's no productivity in a string quartet improvement, right? We're now such a service market. You want to hear a nightclub guy? That's no productivity. Good meal out. You want to go on an ocean liner for a cruise? No labor productivity enhancements there. As more and more of our economy is service-based, the productivity increases that we get from artificial intelligence goes down. Because the very efficient ones end up with no people. Look, automobile manufacturers, there's no people left. GM, Ford, Chrysler, they employ nobody anymore because they've been roboticized as much as they can. So more sectors it'll happen inevitably. But the fear of this massive job loss, I think, is totally, I mean, will the Roomba get rid of all these janitors? I'm not convinced of that. That's really a far-fetched thing. So I'm not too, but we need more education. Because as robotics and AI get better, a lot of low-level jobs go away. I can stop my newspaper, start my newspaper, buy things on Amazon. I do a lot of this, brokerage services, travel services. All this is now becoming automated, right? Now, in terms of Social Security and what they call basic income, they call it. What's the word? I'm not a big. The only way I would be a fan of that is right now we spend a lot of money in social services. And we give poor people, we give them vouchers and coupons and low-income heating, LIHEAP money. We give them welfare money. We give them housing money. You know what? Forget it. Just show your income tax forms. If it's below blank $1,000, here's $2,000 a month. Go away. Now, everybody knows that you bring home $2,000 a month or $1,800 a month, whatever it is, and they expect you to pay. And that will cause you to be an agent that husbands your resources and spends your money wisely. Now, all you want to do is get goodies from the state because the system encourages bad behavior. But we can't afford to give money on top of this. That's just not going to happen. And I'm not convinced we're going to lose the jobs. If we lose the jobs, then we'll have to figure out something else. But I'm not prepared to go there yet. Let's give it 10 or 15 years and see where we are, if it were up to me. I see them like a big mushroom cloud. It will screw us. Okay, so that deficit slide I showed at one point, the primary driver is not Social Security, it's Medicare and Medicaid. When the boomers hit 75, it's even 78 or 80, people are now much healthier. He'll testify to that. People now live much healthier, longer and healthier lives. So this fear of turning 65 and needing health care really is not true. But by 75 or 80, certainly, that's when you begin to need health care. And as we age into that group, a large chunk of Americans age in, health care costs are already starting to eat states out of house and home. Medicaid, because Medicaid's primarily state, right? The feds give 80%, but the state's got to kick in a lot. Medicare is all federal. This is a real problem. Hemlock is a solution. My end of life is heroin, personally, but You know, at the end, it just it'll feel good, and you go to sleep, and you're done. Heroin? Oh, yeah, Kitzhaber, before he had to resign because of the affair and all that stuff, yeah. I follow your politics. They're fun, yeah, okay. But Medicare's a big deal. Yeah, how do we give, we have to give people an incentive not to run the bill up. As long as, you know, your insurance pays for it, and insurance costs are going through the roof too because we abuse it, but it's very hard. This aging problem is exorbitant. The solution really is more robotics and AI. Drive up labor productivity so we can afford. I mean, healthcare can be provided now. You know, your cell phone now can diagnose your stuff. You know, and they look at the picture and you put this and they can tell your heartbeat and all this crazy stuff coming from your phone. Dogs can now sniff out cancer. I mean, there's just crazy things happening. Hopefully there'll be some wild productivity gains in diagnosis and custom medicines, right? That make a big difference. We should be spending lots of money in R&D on that sector because there's huge amounts of money in it, and it will save us lots of money down the road. But if we do nothing, watch out. It'll bankrupt us. They're going to have to raise taxes dramatically to cover the costs.
Real quick, can I interject before we get too many more questions going here? We've got lunches being served as we speak. So on the pretense that you all may or may not be hungry, if you are interested in eating, you might want to grab a ticket and get downstairs sooner than later.
Hint, hint.
I'd hate for the trough to be completely empty when you get there. I also have one other thing. We were going to draw for a quarter of free dues.
Ooh.
Sometimes just to pick a card out of there.
I have one.
Oh, not that one.
Not that one?
Charles Buck. Is Charles?
Oh.
Yay! Okay, well, I've got a certificate here for you, Charles, and I'll give your card to our accounting department when you get ready to use this. Just let them know. One other quick thing. Big shout out to Prestige Audio Video. This entire presentation will be made accessible on the RMLS web.
Oh my God.
So for all of you folks that were taking screenshot photos and recording, I apologize. I could have mentioned that before the presentation, but I didn't. It wasn't anything intentional on my part, but it will be made available to you on the RMLS web desktop. It might take us a day or two or three to get it out.
Well, I'll put you on.
Thank you so much.
It was extraordinary.